And welcome back. The US housing market has been very challenging to track and also to report on given all the volatility in our market so far this year. And also the US housing market continues to be highly rate sensitive, and rates have been absolutely all over the place this year. And this sensitivity to rates right now can be seen on Black Knight's latest housing market update that was just posted today at the time of this video. In this monthly housing market update by Black Knight, they actually track the number of people locking in their rates, whether it's for a home buyer who is getting a loan to purchase a house or it's for a homeowner who is doing a refi. So let me briefly explain. Let's just say you guys are a home buyer, you just got your offer accepted, and sometime after that, you can lock in your rate with your lender. When the house is officially yours, that's the rate your mortgage payment is based on. This is called a purchase rate lock. The same principle of locking your rate also applies for homeowners who are refinancing their mortgages as well. So what Black Knight does, they actually track the number of rate locks. So this is a great gauge to not only see refinance activity, but in my personal opinion, this is a really good way to look at some very early signs of home buying demand. So in today's video, I'm going to share all the latest details with you guys so you guys can make a more informed decision about where you should be buying or selling a house, or if you're just interested in the housing market in general. Of course, I invite you to subscribe to this channel as well. So again, let's go over the latest housing market update according to Black Knight. I laugh because this took me like a half an hour to go over that intro. I don't know why. Anyways, this is a report just posted on April 10th, which is today at the time of this video here. According to Black Knight, rate lock dollar volumes were up 43% on a month-over-month basis. So dollar volumes of rate locks increased by 43% from February this year to March of this year. And this, of course, was driven by seasonal tailwinds, as it's more normal for applications and, of course, for purchase locks to increase in March compared to February. But also we had falling interest rates as well, and of course, stronger purchase market performance than we saw back in February, of course, as well. And by the way, this number right here, a gain of 43%, actually includes the total dollar amount of all loans that have been locked in by buyers or by homeowners as well. But when only looking at the number of purchase loan locks, which of course excludes the impacts of home prices and loans as well, loan locks actually decreased 37% compared to 1 year ago and decreased by 12% compared to March of 2019. So in other words, despite this increase of 43% on a month-to-month basis, we're still down by 37% compared to last year and down 12% compared to pre-COVID levels when talking about purchase loan locks. And that right there is a very early sign of home buying demand down compared to 1 year ago, despite the fact that they increased so much compared to last month. So according to Andy Walden, who's the vice president of enterprise research at Black Knight, he stated the following: "This continues to be an incredibly rate-sensitive housing market, and March's rate lock activity perfectly illustrates this dynamic. This is one reason why I'm really having a hard time reporting the latest housing market updates for you guys, because the market tends to increase 1 month or 1 week and then it decreases the next week. So making it very volatile and also very challenging to report the latest housing market updates." Black Knight also stated the following though. It says early in the month of March, when rates started their climb towards 7% once again, reaching 6.8% in the process, we saw pronounced downward pressure on originations. So in other words, what he means here is that when rates were climbing to nearly 7% for an average 30-year fix, they saw a huge decrease of originations for refis, but also for purchase loans as well. But what happened in early March? We saw the fallout of Signature Bank as well as Silicon Valley Bank, and that caused mortgage rates to decrease big time. So here's a look at rates over the past couple of months here, according to the Mortgage News Daily for people with exceptional credit, of course. So rates as of February 2nd were at 5.99%, but by the time we hit March 2nd, they increased to 7.10%. Then they decreased after the fallout of those banks here A lot of volatility after that, but they ended the month at 6.57%. So what happened was when rates were about 7% or approaching 7%, Black Knight saw a huge decrease of people who are locking in their rates for refis, but also for purchases. But due to the fact that rates went from 7.1 and ended the month at approximately 6.6%, and also reached a low at about 6.38%, they saw a huge increase of activity for refis and also purchases. So according to Black Knight, overall rate lock dollar volume increased 43% compared to February this year. Purchase locks increased 44%, cash out refis increased 31%, and regular refis, which of course is a refi in which you do not get equity of your houses, that increased by 36%. He says here, it's not unusual for rate locks to surge in March compared to February ahead of the spring home buying season, although this year's rise outpaced what we typically see on a seasonal basis. So here's Black Knight's report here called their Originations Market Monitor here. So out of all the people who have locked in their rates in March, 87% came from people who are buying a house. Only 13% came from refis. And by the way, this 13% share is an all-time record low in March. Black Knight also reported that the average rate for March was 6.4%. That was a decrease of 28 basis points throughout March. Now here's something I found to be very interesting as well. This is a look at the top 20 metros in the US based on the total number of rate locks. This is refis plus purchases here. So again, on a month-to-month basis, February compared to March this year, a gain of 42.6%. And the average rate nationwide was just under 6.5%. And the average credit score was 725. To get the best rate, you need your credit score to be about 740 or higher. So nationwide for people doing purchases plus refis, 725. Also, the average loan to value ratio was approximately 82%. Let's just call it 80%, which means for purchases, your average down payment would be 20%. And also for people doing a refi, they would have approximately 80% equity in their houses and 20% using a loan here. So 82% loan to value. Also, the share was 87% for purchases and only 13% for refis. Now, here's what I found to be interesting the most here. Again, a 43% gain on a month-to-month basis on a national level. But look at New York, a 61.1% increase compared to February, far above the nation average of 43%. Also, Chicago gained by 56%, whereas Phoenix, Mesa, and Scottsdale, Arizona only increased by 30.9%. Also, Seattle, Tacoma, and Bellevue, Washington only increased by 32.2%. Obviously, these gains of 30% and also 32% in Seattle is very, very high, but not as high as the national average, a gain of 43%. Other metros that I found to be noteworthy here was Philadelphia, a gain of almost 57%. Austin, Round Rock, Texas, a gain of 62%, much higher than the 42.6% on a national level. But in contrast, look at this. Riverside only increased by 20.8%. Here's something I also want to bring to your attention as well. This is April 2020 through March 2023. These are rate lock volumes by loan purchase. So for purchases as a whole, that was a 44.2% increase compared to last month, a giant increase of 98.4% compared to 3 months ago. But despite these huge increases compared to 1 month ago and also from 3 months ago, when you compare that to 12 months ago, we're still down by 40%. Now here's what I really want you to focus on. This is this dark blue bar right here, purchase locks right here. So March 2023 is much lower compared to last year as well as 2 years ago. In fact, compared to 1 year ago, down by 40%. So despite the fact we saw a huge increase compared to last month, we're still down compared to the past couple of years. And obviously for refis, we saw a huge increase in 2020 through 2021. So the current levels we have right now, even though cash out refis increased by 31%, they're still down by 80% from 12 months ago. Now here's something that's pretty eye-opening here. Here's a look at the average credit scores by loan purchase. What do you guys see here? To me, I see really two things right here. So the orange line right here is for purchases, which is more or less at 730 or a credit score of 730, which has been pretty stagnant over the past several years here. But look at cash out refis. So cash out refis is the blue line right here. So back in 2020, the average credit score for cash out refis was over 740. Now it's only 688. It has been falling big time ever since the early part of 2022. So for example, back in January of 2022, the average credit score was around 725. Now it has fallen to 688. What this is telling me is that the people who are doing cash out refis are the people who really need to do so in order to get cash out of their houses. Also, on the other side of the coin here, for people who are buying houses right now, that has remained steady over the past several years at around 730. And lastly, here's a look at the pull-through rates. And a pull-through rate is right here. Here's a definition. The percent of rate locks that become funded loans. In other words, you lock in your rate, and then approximately 76.7% of the people who lock in the rates for buying houses actually buy the house. So the cancellation rate is approximately 25% for purchase rate locks, whereas for refis, their pull-through rate was only 66%. So I'd love to hear from you guys. What's your biggest takeaway from today's video? Mine is due to the fact that our housing market tends to fluctuate greatly depending on the direction of rates, and rates have been absolutely all over the place this year. Again, making it very challenging to report what's happening right now with the US housing market. Also, this is my biggest takeaway right here as well. A huge increase of purchase loan locks right now, a gain of 44.2%, whereas compared to 1 year ago, we're still down by 40%. So an uptick in home buying demand, but not nearly what we saw compared to the past couple of years. So please comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.